Now more than ever, people are looking to get started investing in stocks. And why wouldn't they? The market's performance throughout the pandemic made a ton of money for investors at all experience levels, and it proved that anyone with a phone can make money in the markets, even if they don't know what they're doing. Unfortunately, a lot of people who were looking to make a come up completely missed out because they didn't know how or where to invest or what to invest in. Even worse, a lot of people actually lost money at the time when they needed it the most. So if you're watching this, I'm assuming you fall into one of those groups. So in this video, I'm gonna give you the basic concepts you need to understand stocks and give you the only strategy you need to make money in the market. And it's surprisingly easy. So let's get into it. We're gonna start with the basics and we'll talk about mitigating risk. Then we'll get into the types of companies that I look to invest in, and we'll get into my strategy that will work for pretty much anyone. So let's start with the question, what are stocks? On a basic level, a stock is equity in a company. Equity is defined as a percentage of ownership in a company. And this is why stocks are also called shares of a company. And in financial settings, they're actually called equities. So when a company is doing well, more people want to be a part of the success. So the stock is then valued at a higher price. But when a company is doing bad, the opposite is true, and so the price goes down. Okay, so now that we know what they are, let's get into buying and selling stocks. So when you buy a share of a company, most people want to invest in companies with a strong track record because you're investing in the performance of the company. So when they do well, your shares will increase in value, meaning that if you choose to sell, you make money. Now we need to talk about compound interest. By definition, the only stocks that actually compound are stocks that pay dividends, and then you reinvest those dividends. However, the behavior of the stock market generally behaves like it is compounding. So let's just pretend like all stocks compound. And what this means is that your money is not growing linearly. Let's take the example of an 8% return every year. If you invest $100, after 1 year, you will have $108, a total gain of $8. However, in year 2, you will have $116.64, which is 64 more cents than you made last year. This effect continues, and it actually starts to mean something the longer that you stay invested. So to put this in perspective, that same $100 will be worth $466.10 20 years from now, which also may not sound like a lot, but let's say you're able to invest $100 initially, and then you invest $50 a month after that for that same 20 years. At the end of that 20 years, you'd be at almost $28,000, having invested only $12,100, which is more than doubling your money. Now, if you're able to add more money, like an initial investment of, let's say, $1,000 or $2,000, or you can do a monthly investment of $500, you can see how this can grow extremely fast. Okay, so I know what you might be thinking. Caleb, stocks aren't that predictable. You can't really expect 8% every year. That's kind of ridiculous. And you wouldn't be alone in thinking that. Most people see stocks as gambling. And the biggest question outside of how to make money in stocks is how to not lose money in stocks. And outside of investing in strong companies, there's a few things that you can actually do. Number one, I would say focus on diversification, i.e. buying a lot of stocks across a lot of industries so that if, let's say, telecommunications, that industry is not doing well, you still have stocks in healthcare, finance, and industrials to balance your losses. Number two, you can hold long term, because over the long run, the US stock market really just looks like this. Like it's a straight line. It's one of the strongest and most robust markets as of now, and it has been for a very, very long time. Will it be like this forever? I don't know, who knows? But what's important to our conversation is these dips that you might see. When these happen, you have to remember that you only lose money when you sell for less than what you bought it for. If you stay invested, the market will likely correct itself, it'll recover, and you'll come out on top. Now that we have the basics of stocks investing down and we understand the power of compound interest, let's get into the strategy of how most people should be investing in stocks. Most people should be looking at index funds, ETFs, and mutual funds. And I'll make a much longer video and get into the differences of these and what they all are. The biggest differences revolve around when they're traded, how they're traded, how much they cost, and what fees are associated with trading them. But basically, they're all versions of the same thing. And the concept is investing in a lot of companies at once. Going back to earlier, the point of this is diversity. With a strategy that uses any of these types of funds, if you're not doing well, the market as a whole is probably not doing well. And that rarely happens for an extended period of time. And when it does happen for a long time, the bounce back is usually crazy. So again, the important thing is to stay invested. Now, I know that's not what you were looking for. I know that these are actually the most boring ways to invest. And when I first heard about these, I wasn't interested at all. They seemed slow, they seemed boring, and I felt like I should just keep looking for some sort of strategy that would just make me a millionaire overnight. Honestly, a lot of that is true. This is slow, it is boring, but why not invest in these until I do find that other strategy? And that way, if I never do, or I never, feel courageous enough to actually try it, I've still done something. And thinking back on our example earlier, I could have invested $50 a month and been able to double that money, as opposed to it just rotting due to inflation. And to me, that means something. That's big. So to give you something tangible in this video, I'd say that the most flexible and accessible option for most people, and what will be best for most people, is ETFs that track an index. ETF is short for Exchange Traded Fund. And the main difference between an ETF and the other funds that I mentioned is that you can buy and sell it like a stock on simple to use platforms like Robinhood, Webull, or wherever else you might invest. Just like a CYA type of thing. This is not investment advice, but a few popular ETFs are SPY, IVV, VTI, VOO, and QQQ. So feel free to do some research on those, see what's actually in them, and see if that's something that you want to invest in. And if you do want to invest in any individual stocks in addition to investing in funds, here are some quick tips. In the short term, just don't freak out. You only lose money when you sell at a loss. Also, whether this is short term or long term, just buy companies that you understand and believe in. And thinking more long term, I would honestly just buy and hold indexes and dividend stocks, because no one really outperforms the stock market anyway, not over a long period of time, unless they invest in real estate. And if you want to get started investing in real estate, you should check out our playlist on buying your first property, and that is right here. In this, we go through all the steps from start to closing and even beyond that. So check it out if you want to get started investing in real estate. Other than that, thanks for watching, and I'll see you next week.